You're listening to the REITE Club podcast, where the focus is all about helping you grow your real estate investment portfolio and live the life you want to live. Come grow with us and join our community at thereiteclub.com. And now your hosts, Sarah Larby and Alfonso Salemi.
Jeff, you couldn't be more right. And Sarah and I, we talk about it all the time on the podcast and different guests that we have about members of our power team, and somebody that's like yourself, that's investor focused, an investor himself, but also managing other people's properties. This is where the team comes into play. This business is not a set it and forget it kind of business, right? Like, you can't do that in certain stages. Okay, you set it, you have your renter in there, but then you have to have your checks and measures, whether it's, monthly, bi-monthly, quarterly or semi-annually, or at least once a year, where you're checking in and going, hey, everything's working okay. And the whole put your head in the ground like an ostrich and no news is good news. But you have to be saying, hey, how can we improve it? What else is going around? Because if we stand still, everything else is going to kind of move around us and we're going to be in a different position. So I love that you take that on as a partnership role. Yes, you are the property management, that's your role, but you're a partner with these people in their property, with these investors that are basically like, you're squeezing the most juice out of the fruit. That's what you're trying to do, right? And that's awesome. It's so important. Yep. So take off the property manager hat for a second, and now you're an investor out east, and you're going out there. And just before we started, on the podcast today, you're talking about the different types of inventory available on the market. And what would, if you're someone that is interested out there and going to invest out east, obviously they talk to a great property manager like you, know the different areas. But what are some steps that you would take to go and find, and what kind of properties would you recommend in that area?
If you're coming to New Brunswick, you're coming for cash flow. If you're coming for appreciation, keep your money in your pocket, because it doesn't happen. And if it does, it's forced appreciation, where you're reinvesting and ultimately, raising your value that way. People come for cash flow, and it's a difficult thing to navigate your way through, and it's a difficult thing to predict before you own it. Because I tell a lot of people, you can look at the numbers all day long. You can look and see what the owner's spending as expenses. You can look and see what his revenue is. You will know what this is going to cost you the day you get your keys. As soon as you get your keys, that's immediately, from that point on, you're going to know what your expenses are going to be moving forward. Now, that being said, single family homes, 5 years ago, you could pick them up super cheap. They would cash flow. You're not picking up homes now. And if you do, you might get lucky out there. But really, the houses are selling so quickly now that the prices are going up, and they're ultimately putting themselves out of price range for any investor to make a go of it. Duplexes and triplexes, similar. They're just, the price points are there. They're not bad for like a first time buy, let's say, where, you're not dealing with as many tenants, your maintenance issues are a lot lower. It's not like a 12-unit building where if your roof goes bad, it's $30,000. If it's a little duplex, you're talking $5,000. So, they're not bad that way. You might cash flow $100 to $200, just depending on where it's located and, what type of heating source it has and all that type of thing. Ultimately, where you're going to really start to see some decent cash flow on a monthly basis is when you get to 5 and 6 and 8, 10, 12, and so on and so forth. The larger, the better, to give you more of an opportunity. That it is, but it's also, as you get bigger, your expenses can get bigger, or do get bigger. Your insurance is more money. Then you have snow removal to deal with, let's say. And then you have lawn care and all these other things that I'm going to come to you and say, this is what it's going to cost. And, I come good news with rent increases, but I also got bad news sometimes. And that's just the way it is.
Yeah, absolutely. So I remember when you had some properties that you were showing us, the taxes were like, they seem really high to me.
Yeah, they are. Yeah. So our tax rate in New Brunswick and it's called non-owner occupied. So, for example, Sarah buys a building, it's a 3-unit. I buy the one right next door, it's a 3-unit. They're both valuated the exact same. even though I'm here and she's there, we actually both pay the same in taxes. It's not because you don't live in New Brunswick. What ends up happening, they have a non-owner occupied way of looking at it, I guess. So if you live in the house, what you get is a credit back on your tax bill for the provincial portion, and you just pay the municipal rate. Okay. But if you don't live there, you don't get the provincial discount, or you get both essentially. Now, some have tagged it a double tax. It's not quite double, but it's, it's fairly close. But also too, again, I go back to, it's a business. And in any business, you have expenses, and you make sure that your revenue is going to be over your expenses, so thus to make money. It's one of the only businesses that you can adjust on the fly, your revenue, essentially. If your revenue isn't enough, you raise rents. And everybody's in the same boat. That's the other thing is, like, if you're coming here, don't think that, you're being ousted, or you're being put in this other class where everybody else has got a leg up on you because they're paying less tax. Everybody investing in New Brunswick's paying the exact same thing.
That's a good clarity, because again, I uncovered that when we were, even just trying to get tax bills to figure that out, and said non-resident, I wasn't non-resident. It was like you just described it.
Non-owner occupied.
Non-owner occupied. And you made it a lot more simpler than any municipal or city person that I talked to. But again, because you have that investor hat on. So yeah, you're right. And that is just part of the business and doing that. So a question in asking, let's go back to, raising the rents. There's got to be some type of tipping point that if you raise them, a certain amount, then maybe you're not going to have a clientele, because all of a sudden, if, McDonald's started selling their Big Macs for $50, well, they're not going to be selling as many Big Macs anymore, right? It's something that a certain price.
Yeah, you certainly have to be smart about it. I use that example of the $200 thing. I just didn't wake up that morning and say, we're going to raise this person's rent $200. We look at and see what the trend is. And actually what triggered it was, again, I used that building. Well, I had a building 2 streets over, we're starting to see that climb. And now I'm looking at my other 24 unit and I'm going, we've got to get there. I'm not just going to allow one owner to reap the benefits and let this poor guy on the other street, who's sitting across on the other side of the country, not understanding that I've just bumped this other one. And, we're working for the better good here.
Yeah, I like it. You got a good pulse on the market. I think that's important, because like it would worry me not knowing like the rules and regulations, but like if I were to invest out east, I would hire you.
Perfect.
Manager.
Thank you.
Like, since I know you, obviously I would hire you. But it is interesting because and I like that you said, like, don't bank on appreciation, because a lot of people here in Ontario, they'll say, okay, well, I'll take a little bit less cash flow. There's appreciation, there's mortgage pay down forever, regardless of mortgage pay down. But the appreciation piece, I think is a big wealth builder. However, when the market takes a tank, because it will at some point, the people that are not cash flowing out in Ontario, I worry for them, right? So it depends, again, when we're in Ontario, if they're buying in Toronto and they're not cash flowing. That's why even if it's like $200, $300, $400 of cash flow in my Brantford properties or wherever I'm purchasing, I'm happy with that. Rent covers it. And it is really great to see, though, like it sounds like out where you are, there's still other fundamentals that work, whether it's, the extra additional cash flow, the fact that you can just increase rents as you need. So I like that. But yeah, go ahead. What were you going to say?
Oh, just there's very few turnkey opportunities right now. A lot of them are ones that you're going to have to purchase. They're going to be crap right off the get-go. But with some reinvestment, which is desperately needed in a lot of these places out here, if you build it, they will come. And I've been going off of that for the last little bit, where we're seeing these renovations take place into areas where nobody thought that you would get a certain rate. But if you make it look good and you go and you do the gray floors, gray paint, white trim, golden, new kitchens, they'll pay. They just would, because the new builds that are taking place, the rents are $1,800, $2,000 a month, up over $2,000 a month. You take a building that you can buy a 4-unit for $200,000, and you get your rents up to where they need to be. It very well could appraise for 290, 300.
Thanks for listening to the REITE Club podcast and joining our community of real estate investors online at thereiteclub.com, where the focus is about helping you grow. We look forward to seeing you again next week. Thanks from your hosts, Sarah Larby and Alfonso Salemi.